What it do, fam? Been a minute since we talked specific stocks, so today we're gonna do exactly that with a little touch on a big brand that I'm sure you're all familiar with. You're watching Secular, and today we're talking about Emart. Now before we continue, we'd just like to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice from a paid professional. When it comes to investments, it's always healthy to take everything with a fair bit of skepticism regardless of the source, and that includes us. For that reason, nothing we say here should be taken as a basis for investment, and you'll have to do your own work and thinking before deciding whether or not taking up a position on any stock mentioned here is in your best interest. Want to know how? Well, if you scroll down a little bit, hit the like and subscribe buttons, we'll do our best to help you figure out how to figure out this game for yourself. That being said, let's get to it. Now, given that it's been quite a while since we've done one of these breakdowns, it probably seems like a wild choice to drop a thing on Emart as opposed to any of the other few stocks that have been making noise on what has been a relatively hushed market as of late. But there are a few things that we've noticed about the stock and the company as a whole that we think are worth a little consideration. All in all, the business is much more than a chain of grocery stores, and we'll get into that shortly. Now, full disclosure, we do not have any investments in this stock at the time of posting, but it's been on a watch list of ours for a while, and today we're going to talk about why. Now, to get it out of the way, let's go over some basic numbers just so we know what we're looking at with the stock. Now, first of all, their price has recovered and taken off from their fall over the course of the pandemic. As for their ratios, their PE is sitting at just shy of 9 times earnings, with a price to book of roughly 0.5 and a price to tangible book of 0.6. Their price to free cash flow is a solid 6, and a modest dividend payout ratio of 10%. All in all, other than their meager dividend, the company appears at its current price to be a pretty average stock, all things considered. Still, as Aswat Damadaran, one of my favorite teachers and professor of finance at the Stern School of Business at NYU, likes to say, valuation can never just be about the numbers. That being said, let's talk about why we're interested in the stock for the long term. Now, we do have a couple of reasons that I think are very much worth considering, starting with their recent moves to expand their business through a very active M&A strategy in the second quarter of this year. Now, you may already know this, but one acquisition that really made headlines was that of a majority stake purchase in Starbucks Korea. Now, they were already the largest Korean owner of the coffee giant's Korean operations with 50% of the ownership, but Emart brought their ownership share up to 67% and by doing so secured their management role. Furthermore, the firm plans to IPO within the next half decade, so that's in the next 4 to 5 years, which is great. Now, as a consumer, this could mean more culturally relevant service, drinks, and merchandise, but as an investor, it's clear that Emart has secured a strong revenue generator for their portfolio. Another important acquisition that they've recently made was that of eBay Korea's operations. This move looks to expand their already strong dominance in the online retail industry in Korea, with their SSG.com and Emart Mall owning significant market share in an already extremely online shopping economy. Now, these two changes aren't earth-shattering, but to me they're significant enough to hold our attention for the time being. Obviously, it would benefit everyone thinking of investing in the company to do their own math and create their own estimate of their fair value before deciding whether or not to buy. Still, with brand dominance in the brick-and-mortar supermarket industry, increasing online presence, and ever-expanding big-name subsidiary list, Emart is one stock that we'll be watching as time goes on. Now, it is earnings season, and a lot of companies are releasing their earnings reports, but Emart hasn't done that yet, so that's something that you're going to have to look for in the coming days. But as a mature business and one of the most recognizable names around the country, we're really encouraged by the strategy that they're taking to expand their current businesses. It's a tough market out there, but after the massive run we saw leading up to this point over the course of the pandemic, an adjustment was certainly expected to some degree. If you're looking for reasons for why the market is behaving the way that it is currently, you may want to check out last week's video on economic trends that have led up to this point. But ultimately, market cycles are market cycles, and if you're looking for a company that has stood the test of time and stood multiple crashes and still come out on top, Emart is one of the stalwarts in our market that may be worth your consideration. Alright, that's it for me. Before I go though, I do want to drop a little thing about this new service called Shared Homies that our guys over at Joongang Magazine have been working with. It's a new startup made for our community for anyone looking for a shared house or rental place in Seoul. It's all in English, so it's convenient for you. If you've got the time, swing over to sharedhomies.com and look over their service that they're building over there. It's another one of those things that I love to support, since really it is a true FUBO initiative. Y'all know, for us, by us. In any case, take care fam. See you later.